imagine waking up to find that everything you buy is on sale. Gas, groceries, that new phone you've been eyeing, the prices just keep dropping day after day. It sounds like a dream, but there is a catch to this scenario. When the prices at the register drop across the board, the businesses selling those items take in less money. And when their revenue falls, the money available for employee paychecks shrinks too. Your wages start going down. Earning less money might seem fine if everything you buy is cheaper, but there's one major expense that refuses to shrink: your past debt. The home mortgage, the car loan, the student debt, those monthly bills stay exactly the same. This budget shows what happens as your income shrinks due to falling wages. Because the debt payment block is rigid, it starts squeezing out the space for your groceries and utility bills. You have less cash to survive on, even though prices are lower. This creates a dangerous trap. When prices fall, but debts stay fixed, your old financial obligations become mathematically heavier. It eats up a larger percentage of your shrinking paycheck, making your debt much harder to escape. To survive this heavier debt burden, you have to make cuts. You stop eating out at restaurants, you cancel your vacations. You do whatever it takes to make sure the bank still gets paid. Now, look at the local business owner who used to rely on your spending. Suddenly, their previously loyal customers are staying home, and their daily revenue drops. This diagram shows the money coming in versus bills going out. As customers disappear, revenue falls, but the commercial loan stays fixed. To avoid defaulting, the business removes wage blocks, cutting pay or eliminating jobs entirely. That newly unemployed worker now has zero income coming in. But remember, they still have their own rigid personal debts to pay every month. One person trying desperately to pay down their debt directly destroys another person's income. The whole system locks into a downward spiral, where every attempt to save money just pulls the economy deeper into the hole. Falling prices also create a psychological trap. If you know a washing machine or a car will be cheaper next month, you wait. You delay the purchase. People pull their cash out of circulation entirely, stashing it away instead of spending it. This stops the flow of money the economy needs. While workers and business owners suffer through this squeeze, there is one group that sees an unexpected benefit: the lenders collecting the debt. Look at this comparison scale. As prices fall, the $1,000 the bank receives in loan repayment can actually buy more than it could when the loan was originally issued. The borrower's burden gets heavier, while the lender's purchasing power grows. This exact dynamic breaks the economic machine. It punishes the people who are actually producing goods and working jobs, while rewarding those who simply hold on to old debt. Normally, when an economy slows down, the government tries to help. They lower interest rates to make borrowing cheap, hoping to encourage people to take out new loans and start spending again. But here is the ultimate trap. If interest rates are already sitting at zero and prices are still falling, that tool is useless. The government cannot push rates any lower to stop the spiral. This photograph from the 1930s shows the human cost of this scenario. During the Great Depression, prices dropped by roughly a quarter. Debts became so heavy that millions lost their incomes, and the economy collapsed into lines for basic food. This photograph of a modern commercial district shows another example: Japan in the 1990s. Even with interest rates cut to zero, heavy debts trapped their economy in a decade of zero growth. History shows us that once this cycle starts, the traditional escape hatches for an economy fail to open. When you look at institutions like the Federal Reserve, shown here, their policies are driven by the fear of this inescapable trap. They are absolutely terrified of falling prices. This animation shows why. They aimed for a slow, steady increase in prices instead. Over time, as incomes and the overall economy slowly expand, the fixed size of old debt stays the same. It gradually becomes a smaller, more manageable piece of the pie. In a world built on borrowing, a permanent drop in prices might sound like a relief. But an economy-wide sale does not actually make you wealthier. It just makes your financial